everyone, and welcome back to our series on trading options. I'm Ryan Victorian, Vice President Financial Consultant here at Fidelity Investments, and in this video, we're taking another big step toward becoming options traders. And that's learning how to develop a plan. In our earlier videos, we talked about the different goals people have when trading options and how there are so many trading strategies available. That's why it's so important to know exactly what you want to accomplish before you get started with each and every trade. Options are also more complex than traditional investments like stocks, so it's important to understand the risks involved before you start trading. With that said, we're going to lay out 4 key questions to ask yourself to help you create an options trading plan. What's your goal? What's your price outlook? What's your time frame? And what could affect an asset's price or its volatility? Let's jump right into the first question. What's your goal for an options trade? Maybe you're trying to take advantage of potential price movements or a change in volatility. Or maybe you're hoping to generate some income from a stock or ETF in your account, or even from your entire investment mix. Knowing that goal is the first step in building your options trading plan. Next, you have to come up with your outlook on the underlying investment's price. We've talked about how traders can be bullish, bearish, or neutral, meaning they think the price of an asset is going to rise, fall, or remain about the same. That price outlook will affect what kind of options trade you want to make. So, how do you come up with a price forecast? You can start by doing some research. For example, on Fidelity.com, you can search for any stock or ETF and get the kind of details that can help inform your outlook. You can check the current price and the price history, review analyst ratings, and catch up on the latest news or upcoming events. You can get the same information on the Fidelity mobile app. Then, options traders tend to dig a little deeper by using 2 common analysis techniques to decide whether an investment has room to rise or fall. First, you have fundamental analysis. This approach looks at a company's balance sheet, income statement, and other financial documents to form a price outlook based on the company's business prospects. Second, there's technical analysis, which looks for trends and patterns in an asset's price movements. For example, you might examine a stock or ETF chart to help determine where you think the price is going and when to jump in or out. In fact, a lot of options traders use both of these approaches, combining fundamental analysis with a little bit of technical analysis to come up with a price forecast. The key is deciding whether you think the price will rise, fall, or remain the same, because that outlook is going to help determine which strategy you want to choose for your options trade. Now we're on to our third important question. What's your time frame? You need to decide how much time to give your trade to play out. Because remember, all options contracts come with an expiration date. And as we mentioned in our previous video on options premiums, the longer your time frame, the more factors you may need to consider in your strategy, such as potential dividend payments, upcoming earning announcements, and changes in interest rates. There's no right or wrong answer when choosing a time frame. It's up to you and your trading style. Maybe you're a day trader, which means you might be mostly interested in options that expire in a day or 2, or maybe a week max. On the other hand, you might like to develop price forecasts that extend out over weeks or months. In that case, it wouldn't make sense to buy an option that's going to expire in a few days if you're expecting a price change over 2 or 3 months from now. That's why you need to make sure your time frame matches your price outlook. And now we've made it to the final question for creating an options trading plan. What could send an investment's price up or down or change its level of volatility? A lot of the factors that drive price swings are related to company-specific events, such as quarterly earnings reports or new product announcements. But there are also macroeconomic events that can drive the overall market or specific sectors, like inflation reports, monthly jobs numbers, and economic growth data. The good news is that a lot of these events happen on a regular schedule, so options traders can plan for them. We make it easy to keep up with these events on Fidelity.com and on our trading platforms. For example, we have a tool that lists specific events related to your holdings, such as upcoming earnings announcements. We also offer a news feed covering your investments. But of course, there will always be unexpected events that affect asset prices too, like a sudden change in a company's management or a global pandemic that affects the whole market. As an options trader, you want to pay attention to what's going on with the companies you follow and within the broader markets. Okay, let's recap what we've learned. You have to have a plan before going into any options trade, and that plan should include 4 things: your goals, your price outlook, your time frame, and the key events that could drive prices or volatility during that time. Now, of course, no one can predict the future, but building a plan around these 4 elements is ultimately how you can choose the right options trading strategy for your goals. And now that you know how to set up that trading plan, we're finally ready to dive in and explore some specific strategies you can use. So get ready. Our next videos will explore strategies for buying and selling options. As always, if you have any questions on options trading, please drop them right in the comment section below. Thanks for watching, and I'll see you next time.